Hey folks, welcome to the Rational Canadian podcast, hosted by Michael Shahadi. Let's first understand what the short-term debt cycle looks like, generally speaking, and then we can then carry this over to where we are at today in Canada, and in most of the world actually. So the short-term debt cycle is between 5 to 8 years, and it's primarily influenced by money printing, immigration, and interest rates, although there are other factors that also influence it. But I would consider those the major levers that the government can use to influence it. It starts as an arc heading upwards on a graph, and basically first creating a concave down shape, followed by a concave up shape. And what this is you can think of it as section A and section B. The first half of a short-term debt cycle is usually started with interest rates near or at zero. Money printing or immigration can be in excess. So those two factors go to high values, and the interest rate goes to a very, very low value. And what we end up seeing in these situations is extremely cheap borrowing, high spending, high valuations, a lot of competition, meaning high demand for products because money is very cheap and a lot of people have a lot of it. Employment is all over the place. So there's a lot of power to the employee, and the employee can go and find other roles and kind of put employers against each other to compete because everybody is growing and everything is great. Essentially, you can't lose. Everybody's winning. And it gets to a point then where there's been too much exuberance. Money has been cheap for so long, everybody's winning too much, and the competition for goods and services is at a peak, which creates what we know as inflation. Basically, there isn't enough to go around, and so what does exist on the market is being overbid and creating this inflammatory behavior for all commodities, all goods, right? Shelves are empty, things are going 20, 30, 40, 50% bid over prices, and it's not good for anybody. Now, when those goods get overbid and overpriced, what happens is then the businesses that are selling those goods decide, well, if he was willing to pay, for example, let's take housing. If they were willing to pay 500,000, why don't I ask 600 or 700 or 800? And essentially, they just keep raising the price until they find out that the consumers are no longer interested in purchasing that product, which over the last 2 to 3 years was non-existent, meaning we were unable to find a ceiling for the price of goods, which is a really, really bad outcome. And this was a global, more or less specifically in Europe and North America, an issue around the world. So what ends up happening is then that businesses like Shoppers and Zehrs Food Plus and all these different businesses increase their prices of their products. Okay, they're trying to find that ceiling. Well, when they increase the price of those goods and services across a broad spectrum of buckets, we end up seeing that then the regular consumer goes to their employer and essentially demands a raise. They say, hey, look, inflation's going crazy. I haven't received more than a 1 or 2% raise over the last 5 years. I want more. And you start seeing people going out and picketing. And then this then leads to the employer having to increase the pay or minimum wage or the base pay of employees. And then the business, all it does is after it gives, let's say John Smith a raise from $10 to $13 an hour, he just goes and raises the price of the bananas equal percentage, right? So if there was a 30% increase in hourly rate, then they're just going to go increase their goods or their services by that same value, right? Basically, the employer never loses. What ends up happening is then that the consumer just ends up paying for that increase in wage. And you can see where I'm going. It creates a chicken and egg. So prices go up, people demand raises, people get the raises, and then prices go up again. And then, and that happens over and over and over, which can spiral out of control and create, what we see in other countries around the world, Venezuela, Lebanon, where inflation is just incredibly high and it demolishes the entire middle class and anything below that and leaves only the wealthy. So when the government starts seeing this type of behavior, what they do is they start pulling on these levers I mentioned earlier, whether that's interest rates, immigration, or money printing. Mostly they use the interest rates because it has, although a lagging effect, it is very effective in stopping the exorbitance that exists in goods and services. And so what we end up seeing when we talk about that concave down, concave up life cycle, we see that once things get too crazy, the government steps in and starts bumping up interest rates. And as those rates go up, people spend less. And this creates a deflationary period, although it's not deflationary in the idea that bananas that were $2 a pound are now $1 a pound. Instead, what it does is businesses, which for the most part refuse to reduce the prices of their goods and services, instead start doing layoffs, getting rid of employees, office spaces, and different assets in order to offset the losses from the deflationary period and the lack of spending from people. And then we create another chicken and egg situation, which is people spend less, which means employers lay people off. And then those people who are laid off then can't spend because they don't have income anymore, which means spending goes down even further, which means employers receive even less income, less spending on goods and services, and then do more layoffs and so forth. And then that chicken and egg situation then eats itself away until we hit the inflection point at the bottom of the second, which is the concave up. At this point, the government realizes that it has created such a deflationary environment that it has caused an increase in unemployment, and which then leads to a decrease in GDP and capital growth domestic product, GDP per capita. And what they do is, and they start pulling on that lever again, and they start decreasing interest rates, which allows employers to go and borrow money at extremely low prices, which allows them to expand their businesses. And rather than relying on the spending of people, they can then just rely on the credit, which is super, super cheap. Now, what does this mean? On the B side, meaning the concave upside, which is when we're at the lowest point in the economy, we see that spending slows, the cost of debt is very, very high, which forces people to readjust their spending habits and focus on paying the things that they need to spend money on. And the prices of goods slows from an inflationary period perspective. Now, we talked about interest rates being at zero and money printing and immigration going towards infinity, in essence. That is the first side of that short-term debt cycle. And then on the second side of the short-term debt cycle, we see that interest rates that in the first half of the short-term debt cycle were at 0% and headed towards infinity, in this case, an increase until we see a deflationary period. On the second half of the short-term debt cycle, we see that interest rates, whom presumably were high, are now headed towards a 0% rate in a 0% environment, which will then stimulate the economy. Now, let's look at this from the perspective of Canadians. From 2020 to January of 2022, which was 2 years, we printed 22% of all Canadian dollars. 1 in 5 Canadian dollars didn't exist prior to 2020, which is incredible. This means that anybody who is holding any cash, liquid cash, lost about, give or take, a 22% of the value of their dollar, which then leads to an inflationary environment, right? Because if the Canadian dollar is worth less, that means that every company that imports products into our country has to pay more Canadian dollars in order to get those goods or services into the country. And so that was an inflationary aspect over the last few years. On top of that, from July of 2022 to September of 2023, so let's say 1 year, we had 1.158 million people come into the country. That's an increase of 2.9% of our population increase. Now, generally speaking, I'm pro-immigration. Both my parents are immigrants. I'm a first-generation Canadian. I am pro-immigration, but it has to be with a rational mindset. I mean, we don't even have enough houses to support the Canadians here in this country. We have, and we've talked about this both at the federal level, provincial level, how are they going to be able to increase the amount of houses on the market? Today, Canada builds about 286,000 new homes each year. That's according to an article in the Global News. Now, we are about, I think last I saw was 3.5 million. Oh, so yeah, we're 5.8 million homes in the country to tackle the affordability crisis. So one can only assume then that if we're allowing 1.16 million people into the country every year, and we're only building 286,000 houses every year, that the issue, rather than the gap getting closed every year, the gap is actually increasing year over year, because we're letting more people into the country than we can actually build houses for, not to mention the people that are already here that don't have houses. So this is going to be a huge problem. And I'm going to go into more detail in a different episode about like what I think about the housing side. But this is just to show that this is creating an increase in demand, and immigration is hurting the short-term debt cycle, because it's almost creating an imbalance in one of the biggest aspects of day-to-day Canadian spending, which is on your mortgage and your housing. And then the last thing I wanted to mention was the interest rates, which was that third lever, just to give you guys perspective. So the Bank of Canada, over the 2-year span during COVID, I think it was from March of 2020 to March of 2022, had interest rates. So the Bank of Canada rate was at 0.25%, essentially zero. So for 2 years, interest rate was at zero, which created mass exuberance on the Canadian side. So now, kind of looking at this chart, which I'm going to post on the pod, but where I see us today is we've definitely gone through the cheap borrowing, you can't lose side of the graph, and now we're somewhere on that B side, which is on the deflationary side. We're seeing unemployment tick up. We're seeing multiple quarters of negative or basically zero growth on the GDP side for Canada. The Canadian dollar against the US dollar is falling, meaning one US dollar is getting more and more Canadian dollars as the weeks go by. And interest rate hikes have more or less paused, which means that although the interest rates have a lagging effect, the government is already seeing that effect. And so they're thinking that we are either bottoming out now, and which means bottoming out would be now into Q1 of next year, 2024, and Q2 maybe, which would then mean we would see a decrease on the Bank of Canada rate sometime around end of spring to summer of next year, depending on how the economy behaves over the next two quarters, I should say. So part of me wants to think that, look historically at what's happened when we had this type of behavior, meaning rates coming up and then trying to slow down that inflationary side. I look at the dot-com bubble, which it's not a one-to-one, but that took about 2 years to hit the bottom in the stock market. If you look at where it plateaued and then when did it stop going down, it was roughly 2 years. That was between the summer of 2000 and the fall of 2002. And then if you look at the GFC, the Great Financial Crisis, which started in the fall of 2007 roughly and ended in the spring of 2009. When I say started and ended, what I really mean is, where did it plateau in terms of height in prices of stocks? And when did it plateau on the way down? And that one was also roughly about 2 years to hit the bottom. And so one of the things I tried to at least explain is that people think a recessionary period is like it happens, so fast and you just bounce back. But the reality is that when something starts behaving in this way, it typically lasts a long time. And so I would say that 2024, this coming year, is going to be, the entire year will probably be slow. Even as rates come back down, they're not going to come back down as quickly as they went up. They'll be coming down much slower as the Bank of Canada tries to reach that 2% inflation rate. I think right now we're at like about 3.5. So I am, not a financial analyst, but based on the information, the public information that I could see from the Bank of Canada and the different statistics that Stat Canada is releasing on employment and immigration, I'm probably going to say that about for this short-term debt cycle that we're seeing in Canada, we'll probably not see us coming out of this until end of 2024. 25 is probably when we'll start seeing the bottom, when things will start coming back up. And that'll be driven by the decision of the Bank of Canada on the rates, which if we continue on the trend that we're on now, rates will probably start seeing a tick down, starting with a quarter point sometime in the spring or in the summertime. And that'll lead us into the restart of the short-term debt cycle, which will then follow. As soon as we start seeing rates come down, it's going to be followed by, of course, cheap borrowing, high spending, high valuations, you can't lose mindset. And then it'll repeat itself again. So, yeah. Thanks for listening. Until next time, TRC out.